Hello, welcome back. At this point, it may be beneficial for traders to short whatever Cathie Wood is touching, because as you'll see, Unity Software, another darling of Cathie Wood's, is actually down almost 28% right now after hours, completely decimated as well. And if we take a look at the stock news, you will see what's happening. What made Unity Software shares plans actually 35% at some point, absolutely insane. You will see that after hours trading on disappointing guidance is what caused it, and we can take a little bit of a closer look at what happened. You will see that the stock plummeted 35% at some point, over 35%, lost 177.6 million in the first quarter, 60 cents per share that is, and last year it had lost 107.5 or 39 cents per share, so a massive decline over here. And this is what I have been talking about in terms of stocks that are not net income positive. When a stock is actually losing money, the normal course of action is that they keep losing money. They have to adjust a lot of things and be massively better in order to actually turn to profitability. It's not an easy thing, it's not automatic, and just because the company is having high revenue doesn't mean that they're a good company to hold, not even close. So this is why I wanted to, and I have long talked about all these companies that are losing money. You have to be super careful about owning them. They can actually completely and seriously hurt you, because last year you would have expected, the Unity to maybe creep in actually even lower with this earnings report, maybe actually losing 30 million. But now, no, they're losing almost 100% more than what they lost last year. So, this is really bad right here. And so revenue jumped 36%, but what is revenue if you keep losing money is the thing, especially in this environment. Consensus was for 8% of adjusted per share loss on 321 million in revenue, as you can see. And revenues from credit and operate were up 65 and 26% respectively. But again, what is revenue without being able to make profit? I don't know. I mean, if you are selling things, that's a good thing, because it shows the ability to sell. But the ability to make money is much more important than your ability to sell, because you can sell all sorts of things and still lose money forever. That's not what you should be aiming for. Successful company is about selling and making profit. Very important. And so we're going to take a look at the stock right here and see whether this is a potentially interesting purchase after it's gone down that much, almost 80% approaching right now. It's probably going to be more than 80% tomorrow when it opens up at almost $35 is where it is right now, and may actually open up lower. And you will see over here that it's actually below its IPO days, significantly below its IPO days. Absolute bloodbath here. And look at this, P ratio that is negative, price to free cash flow that is negative, terrible stuff, outstanding shares. Look at this insane print of extra shares here. This is madness to actually hold this company, especially as it was going higher, like super madness, insane. And even the revenue growth is not insane. I mean, you would expect this to be much higher, at least. But no, it's okay, but it's not absolutely insane as you would expect, because otherwise, what else are you buying here? Net income growth is down, losing tons of money, free cash flow down. Total equity growth is the only thing that's increasing because of this, because of the outstanding shares that actually investors are buying. You will see that all of the metrics are red here. Terrible. And of course, the returns are negative as well. And yeah, let's take a look at the financial statements here, and we will see what I told you about, that the revenue has been increasing, but you're not looking at like 200% or 300%, like insane increases. This is pretty nice, but relatively steady here. And remember that you are losing profit for it and actually going in the negative, more and more in the negative every year. Terrible thing to see for a company. And the balance sheet is probably increasing here, as you could understand, in terms of total equity, because additional paid-in capital is the story with all these super overvalued companies. They are actually utilizing stockholders for their capital gains. And cash flow statement, we're beginning with negative net income, and of course that translates to even more negative net cash by operating activities over here. Actually, it's not more negative. It's actually a little bit more positive, but that has to do with stock-based compensation is what adjusts that free cash flow a lot in the very end, because you will see that it keeps increasing. The company keeps paying more and more in terms of stock-based compensation. thus kind of affecting free cash flow, and it's still negative, even though they are paying all their expenses through stock-based compensation. It looks like for employees. Financing activities, look at this, values super positive. Financing, pretty much borrowing money all day long and issuing stock. Pretty terrible for a company to see. There's not much, there's no cash made from operations, and net cash from investing activities. At least the company is investing a little bit and acquiring stuff. Actually, surprising, because they're not really making enough money. They're actually using stockholders' money to acquire stuff. It looks like, okay, but the free cash flow is still negative. And if we take a look at the stock evaluation tool, you will see here that what I said, revenue is increasing a little bit, but what can we do with this net income? It's fully negative here, and free cash flow also negative. So these margins basically play no role here. The only thing that we could try here is go something like maybe 15, 19, and let's go 30, 23 in terms of revenue growth, which could be actually very, very optimistic here. And go with marginal profitability, 1, 3, and 5% here could be something to aim for. Free cash flow margins of, let's just say, 70, 80, and 90%, which is fairly typical. 13% for an annual return for the company. And if we hit calculate, you will see how far we are from the current price of this super overvalued company. There's just no way I would be buying this one, and as you can understand, it's fairly obvious why this company is going down and down and down and down. And remember, it used to be, let's actually see, what was it, like 300 or something of that sort, 210. And right now it's 34. And I would be very, very surprised if it doesn't keep falling. So as I'm seeing the company right now, this is definitely not a buy. I couldn't even be close to this one being a buy right now. Even though I love Unity, I love gaming and all that, there's just no way I would be entering this one. There's absolutely no way. And this is one of Cathie Wood's prime holds. Absolutely insane. So yeah, if you're holding ARKK or any other garbage of that sort, I'm really sorry about this. I mean, maybe it's a good opportunity to start deploying money in some companies that are actually good companies, because this one's the garbage in terms of financials. Thanks for watching the video. I hope you enjoyed. Please leave a like and subscribe, and I'd love to see you around if you're not a subscriber already. Remember that you can become a Patreon and get access to this tool so that you can analyze your stocks your own way using the tool. There's unlimited access if you're a Patreon. You can find links in the description box below. And thank you for watching this one again. Remember to take a look at this video that I made earlier, and it's about 5 stocks that I would be buying right now, which I think are great value. And thanks for watching this one again. See you soon. Bye bye.